question is just that because your report calls quick commerce a decadal opportunity, help us understand what are the key factors that could determine who will win in this space over the next 5 to 10 years. Any important metrics other than the regular ones that you're tracking at the moment?
Yeah, sure. Thanks for having me. So, what we see is Indian retail industry. It's like a large trillion-dollar industry in terms of size, but it's still largely unorganized. If I look at a category like grocery, more than 80% is still large, like driven by 10 million mom and pop outlets. We've seen a modern trade making some inroads, but still been restricted to top cities. And then we saw overall growth starting to stabilize in modern trade, while e-commerce did not really make any meaningful dent when it came to the grocery segment. What we saw with quick commerce is a very strong growth over the last like couple of years, driven by the dark stores, which do provide convenience. Pricing also has been reasonable, and consumers towards them more and more frequently. Also, unit economics, they were able to crack with Eternal getting to EBITDA break-even in 1H of FY25. What we've seen subsequently is a land grab phase in which everyone started investing more aggressively. We've seen that happening from the like three quick commerce companies, but also like other retail companies are also retail and e-commerce companies are also looking at this opportunity very closely. They're also starting to invest. It's really about chasing and getting the first mover advantage, and we believe that the near-term metric to really judge them by will be ensuring that they maintain a very strong growth while at the same time keeping the EBITDA losses in check. I mean, I would not judge them by immediate profitability, even if like over the next couple of years they can get scale. And what we are expecting is just between the two companies which we cover, Eternal and Swiggy, the net order value will increase from about $4 billion in FY25 to $16 billion by FY28. So that's quadrupling of the size of the business over the next 3 years. While we expect the losses to be kept in check, we expect that the model which we've seen in case of food delivery, which is initially getting the scale and then like focusing on profitability, is something which will be replicated. Having said that, this is going to be a more competitive industry. The size of the industry is much larger compared to what the food delivery industry is, and it's going to remain competitive. So it's more a question of right now just getting the size, and we expect margins to follow.
So how do you see unit economics evolving across food delivery and quick commerce as the market matures?
Yeah. So in case of food delivery, we've already seen that happening. Food delivery, if I look at over the last 3 years, the loss like in FY22, this industry was making about 20 billion of EBITDA loss. In FY25, we've seen that to about 20 billion EBITDA positive number. In case of quick commerce, what we believe is going forward, like say FY26 will remain a year in which there will be like peak losses, but beyond that in FY27, we expect Eternal to get to break-even level at EBITDA level, adjusted EBITDA. In case of Swiggy, we expect it to take longer, about FY29 or 20, FY30 is when we expect, in terms of margins, we expect the food delivery margins are getting closer to 5% now and on average order value, while in case of quick commerce, we expect that to take longer, but we do believe that about 5% is possible in the medium term.
All right, Kunal, the report states that the food delivery is more resilient than the QSRs. Now, is this primarily due to the capex-like models, or are there consumer behavior shifts that is driving this advantage?
So in the report, what we've done is we've done extensive comparison and benchmarking between food delivery and quick service restaurants, both the space which we look at very closely now. What we've seen is, and like we are looking at doing this for evaluation benchmarking, what we see is Indian quick service restaurant industry has seen increase in EBITDA, but they have not been able to generate free cash flow because whatever increase in EBITDA they've seen, largely that is getting reinvested in capex. The big difference which I see between the two is that in case of food delivery, there is almost no capex. There is no working capital. So whatever EBITDA they are able to generate, that's getting reinvested in another very large high growth opportunity, which is quick commerce. So that's a space which we prefer between the two. And we expect even in terms of growth trends, if I look at quick service restaurants, over the last 6 years, FY19 to FY25, we've seen QSR industry see about 13% revenue CAGR, but that's been driven by 14% store CAGR. and like that's fairly capex intensive. Many of the companies which were like say managing with like in case of Jubilant FoodWorks, the EBITDA, like so the capex was about 1.5 billion per annum in FY19, but that number is now about 7 billion in FY25. So while we've seen not a meaningful increase in EBITDA, the capex intensity has been fairly elevated in the quick service restaurant industry, and that's the reason why we believe food delivery is the better place to be in.
Right, and also help us understand in terms of the audience that quick commerce caters to. Do you expect quick commerce to evolve into a true mass market channel, or will it remain an urban value proposition in the near future?
In our projections, what we have kept is quick commerce industry catering more to the affluent consumers by FY28. But what we believe is once they achieve scale, they will be in a position to go mass market as well. For now, our expectation is that there will be about 45 million households, which will be spending about 5,000 rupees monthly on quick commerce. That can be across various different categories. It can be home and personal care, it can be consumer electronics. There are various products which they can start adding. And beyond that, once they achieve scale, like if they do get to the scale which we are expecting, which is about $16 billion just between the two quick commerce companies, I think they will have many margin levers which can help them bring the cost down. So the margin levers which we are talking about would include better pricing power when it comes to negotiating with the brands. We expect advertisement revenue to come in because the kind of details which these companies will have over the household consumption patterns will be very valuable for the companies. And also we expect the average order per dark store will keep on increasing over the next few years. So some of these will help them achieve better level of profitability, and some of that can get passed on to the consumer. And as the pricing becomes more competitive, they can start going beyond the affluent 40 million households and into the mass households.
So that's the take on the scale at which quick commerce companies could grow and the audiences that they could target. But help us understand in what ways might large incumbents right now, the entire retail space in the unlisted sector like Reliance or Amazon retail, how could that reshape the competitive intensity that we are seeing amid the listed space right now?
Yeah. So this is still going to be an evolving space, and we don't expect a quick result in terms of market consolidation, the way we've seen that in food delivery happening in case of quick commerce soon. But the way we are looking at this industry is that everybody will look at their own sweet spots and their own target markets. In case of the larger e-commerce players, they will continue to focus on a much larger assortment. For quick commerce, what really works is fast moving items which the consumer needs, but it will not be able to cater to industries in which there is a wide assortment. Like fashion is not something which they are like well positioned, or footwear is not something which they are well positioned to do. So they will be doing the fast moving items. E-commerce will have a much broader offering, and they will not be delivering within like say 30 minutes. They will have a larger assortment, while delivery times could be longer. In case of physical retailers, it's going to be about the consumer footfalls, and they will look at more on scheduled deliveries. While they will look to bring the delivery times lower, at the same time, they would not go into the dark store model, wherein they are close to the consumers in every location.
With that, with the heavy focus on the dark store expansion, how should players balance the speed of scaling with profitability discipline? If you can share your thoughts here.
Yeah. So what we've seen is after like Blinkit achieved EBITDA breakeven, I think there has been a big burst of dark store expansion. What we saw was the number of dark stores have doubled in FY25 across most players. I expect the now FY26 to be a year in which there will be some consolidation, while the heavy growth will still continue. At the same time, you will not see doubling of store count, and the focus will be on driving efficiencies to uh, bring the EBITDA losses to lower levels compared to what we see. I mean, FY26 could be the peak year. After that, we expect the dark store additions to get normalized, while the focus will be on driving consumers per dark store per day.
That's an important metric. But before we let you go, just help us understand the kind of impact Rapido's entry could have into the food delivery space. Because I remember when this announcement was made, for a couple of days, you had both the stocks in the listed space that saw very deep cuts. So how do you view Rapido's entry into food delivery with low delivery fees? How could that impact the current duopoly? And how sustainable do you think Rapido's model could be in terms of their pricing?
I would not comment on Rapido and what they can do, but if I look at the economics of this business, it makes it very difficult to break even at 25 rupee or 50 rupee because the average rider will want about 25,000 rupees per month, which is about 1,000 rupees per day. And like if he's working for 10 hours, you need at least like say 100 rupees per hour, 50 rupees per delivery. So if someone is looking at like 25 rupees, 50 rupees pricing, that makes it very difficult to work out, and it will require like a lot of cash burn. What we've seen is today's Zomato and Swiggy between them carry about 1.5 billion orders annually, and at that scale, we see variable cost per delivery for these players to be about 60 rupees, in like say purely for delivery and about 80 rupees in total. So to beat them in terms of unit economics is going to be a challenge for a new player. And even after many years, I mean, like, say, if I look at till FY 22, 23, Swiggy itself, with large scale, was still reporting about like 15 billion of annual losses. So it seems challenging for any new entrant to really make any meaningful inroad. So we continue to see this as a like duopoly structure, which will keep generating healthy cash flows.
All right, Kunal, with this, we'll let you go on that. Thank you so much for taking the time out today and speaking with us and giving us a sense that how are the trends shaping up when it comes to the quick commerce space.